Hello, everyone. Cousin just called you. Want to know if you'd passed your real estate test yet. They've been on the internet, on the Google, found a mortgage company to give them some money, and then they went to Zillow. And surely they're not going to call you first and ask you where to find a house and how to get a mortgage. They're going to try to do all that themselves. So we've got them there. They've called you. They want to see a house. So, oh no, what do you do? Well, you know you're going to be real happy, 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 happy. But what do I do first? Oh no, what do I do first? First thing you got to do is find out if they're working with another agent. If they are, leave them alone. Tell them, you'd love to help them, but they're working with an agent. If they ever want to change, you'd be glad to be there for them. But if they are working with one, leave them alone. Next thing you have to do, as required by Alabama law, is to furnish them with a RECAD form. That's a real estate consumer agency disclosure. That just tells them that you have a real estate license and also have some responsibilities to them. If you want to, there's a booklet on the ARC website that tells people how to work with different types of relationships, which we'll get in the next slide. And next thing you need to know, are they working with a lender? Because in this market, if you're not pre-approved and ready to go when you place an offer, you forget it. So let's get with a lender. Get some financing lined up. Here's the RECAD law. It just says this is required. It's mandatory. You've got to do it. If you're working with the buyer side, you're going to do one for them. If you're working with the seller side, you'll do one for them. You don't do them for both unless you're representing both sides. And here's what the real estate consumer agency disclosure form looks like. You've all seen it. Everybody in Alabama uses this same form. All our relationships, when we first talked to somebody, when your cousin called you, you didn't have a relationship with them, legal real estate relationship. So you start out as a transaction broker. That means no relationship. You can't give them advice. And that's really what you want to do as a single agent, is give them advice. That's what you would move to first, single agent. And this form, the real estate RECAD form, does not create agency. It just tells them you are an agent, and it gives them the things that you are required to do for them and some things that you may do for them. If y'all remember this in pre-license, these are the hard questions you had to answer for everyone. Now, we're going to create agency with your cousin. Don't you think they're going to want you to advise them? Even though they've already figured everything out on their own, they know everything, they've been on the internet. But you can't create agency without a second form, and that's going to be this one. So up here, creates agency. That's a buyer agency agreement. This allows you to give them advice. Otherwise, keep your mouth shut. Fill out the form. What do you want to offer? What do you want me to write here? You're not allowed to give advice unless you have agency with them. Now, this just is a simple form, 2 pages. You don't really have to get real detailed here. What are they looking for? They're going to buy a house or a business, or what is it they're looking for? Just generally down through here. And remember, listing agreements, and this is a listing agreement really because you're helping them find a house, not sell a house. They have to have an ending date with no automatic renewals. That's what we are right here. Then over here, we're going to look at the commission. You're probably not going to be doing any exchanges or leases, anything like that with this. So you're going to come in here, and if you want to, you can say, we'll accept 3% right here. And if they sign this saying they're going to pay you 3%, then you find them a house that is only paying 2.5%, then your buyer is going to have to pay you that extra 0.5%. Some of the real estate companies are also charging a administrative fee or a junk fee of some kind, and it'll be from $200 to $1,000, and that would go here plus the commission. Options, you're probably not going to be doing any options. Lease, you're not going to represent the tenant in a lease anyway. You're probably going to be representing the owner. Now, third parties, that's the seller's going to pay this commission. So if they pay 2.5, right here it says that 2.5 will be credited toward what you owe them, but they're still going to owe you that other 0.5%. Don't leave money laying on the table. All right, now that we've got our buyer agency agreement, we can start looking at what we're doing. They have been pre-approved for $250,000. Does that mean they're going to buy a $250,000 house? No, not necessarily. They may find one for $100 they like, but they can buy up to $250. Cousin's got a credit score of 720 and they got $10,000 in cash. So what kind of loan could they use? Well, the loans would be a whole different class on what we talk about. So let's just jump here real quick and review them. Conventional loans. Conventional is someone that's got probably a house that they are selling and they're going to have a wad of cash that they can put down on the new house. If they've got some money saved up, a conventional loan. Typically, conventional loans will be 80% of the purchase price. You can get them up to 95%, but you've got private mortgage insurance you'll have to deal with on anything over 80%. Next type loan, the one your cousin's probably going to want, is an FHA loan. And this is better with first-time home buyers. Credit's not quite as good. They had a 720 score, but with an FHA loan, you can get a loan down to 620 credit score. Your rates are going to be higher, but everything's negotiable. And then a VA loan, if your cousin's a veteran, they can get 100% financing on this VA loan. So let's just say they're going to get an FHA and move ahead. Now it's right. It's a general residential finance because they're getting an FHA loan, and they found a house they love that's $220,000. So you write the offer for say $200, and they're going to put $1,000 up as earnest money. Earnest money is money that Ernest puts up to show he's earnest about doing the deal. And here you put the FHA financing. So that's pretty much what we need to know for this. Now, what does a net sheet look like? Just created this one. I took the one that was on the MLS site and looked it over, and it just wasn't giving me what I wanted to get out of a net sheet. So I put this one together to kind of, I guess, make it clearer on where all the money is and where it's going. So we got 3 parts to this. So it's as easy as 1, 2, 3. Here's one right here was not filled out. And then here's one completely filled out for your cousin at the $200,000 price. So let's break this down into its parts. Remember this over here, KISS? Move me out of the way here so you can see that. KISS, keep it simple, silly. Keep it simple. 3 simple steps. Step number 1, what's your price and what kind of loan do you have? Our price is $200,000, so we put it right here. It's an FHA loan. We look at our closing expenses in the first part. The attorney, they don't work cheap. You can bet on $1,000 now to close a deal with a mortgage on it. Now, is it going to split? Normally, it will split between the 2 parties. So your cousin's going to pay $500 here. Now, how much is the loan going to be? It's an FHA loan on a $200,000 house. If you remember from pre-license, that is a 96.5% loan to value. So our $200,000 loan, purchase price, we can only get a $93,000 loan on that, but that's okay. We're going to come back and look at that and say $93,000, I've got to pay, what is this FHA upfront fee? Yeah, you got to pay 1 3/4% upfront or load it into the mortgage for an FHA. This is a risk. It's a risky loan for them to loan you 96.5% of this money. So we've got that. So our loan, we're going to get $93,000 worth of credit on this deal, but we're going to have to pay back $196,000 because we added that funding, that FHA mortgage insurance premium on top of it. We got a couple of other expenses here in our closing expenses. We got a recording fee. A deed is $1 for every $1,000 that you bought. $200,000 house, that's $200 for the recording fee for the deed. There's a recording fee for the mortgage as well, a little more, $1.50 per $1,000. So we got that. And then there's going to be some title insurance. If the sale is cash, the seller will pay normally. And if it's a split, got a mortgage on it, then it'll split. Title insurance, as a rule, will be about $6 per $1,000 of coverage. So we got a $200,000 coverage. That's going to be $1,200, and that will split if it has a mortgage. So here are our only 4 little closing costs in this section. We good? Let's move to step number 2. Well, maybe I should have read this before I started talking about it. Here it is, just blown up a little bit so we can see it. All right, upfront mortgage insurance, FHA. See, on all FHA loans, it's 1.75%. It's financed into the loan. Then on top of that, there's also another insurance premium that goes into that loan. And this is figured on the current balance. So it will change each year as your principal comes down. Currently on a 96.5% FHA loan, it's 0.85% of the mortgage. And what they do, and we'll explain that here in a minute. Just here's what you got to deal with. How'd you figure that loan to begin with? You had a $200,000 purchase price. Y'all remember this from pre-license, our T formula. $200,000, the house, loan to value, 96.5 or 0.965. This is times this will give you this. So that's our loan amount. Now, if this was a 80% loan, we'd use that same formula, but would multiply 200 times 0.8. This would be a conventional loan to value where mortgage insurance is not required. And if you we're going to see here in a minute, the mortgage insurance is going to take a bite out of you. So here's what your conventional loan would be. All right, here's our title insurance. There's cards here on our website. We've got these where you can look them up, or you can go on the internet and find somebody to give you a price. This one, we're looking at what do I got here? $150,000. That's wrong. It should be 200,000. Got my line in the wrong place. 200,000. So yeah, roughly $1,000 for this title insurance. Now, as price goes down, the percentage is up. So a real expensive house, it's not going to be $6 per thousand. It might only be $4 per thousand, but most of your sales are going to be in this range, 150, 200,000. So you can figure $6 per $1,000 of your sales price. And we've always got these links down here where you can click and look at it. Step number 2. Got our part. Now let's look at this part, the lender expenses. These were closing expenses. These are lender expenses. They will charge you an appraisal fee. This is one of the things you're going to have to pay the lender up front for an appraisal fee and a credit report. About $500 for the appraisal, $50 for the credit report. Now, all these numbers are not carved in stone. You may get an appraisal for $400 or $600, depending on the size of the house. Escrow, tax setup fee. All the lenders are going to charge you a little jump fee here to start collecting your taxes and set up an account for you. And you always have to find out if it is in a flood zone. $25 for that. And if it is in a flood zone, you're going to have flood insurance. Okay. Now, you've also got, since you're going to get this loan, you're going to have to pay interest on it every day that you have it. So you will pay, your cousin will pay interest on this loan. We're going to close on April 15th. So there's from there till the end of the month, April 15th, the borrower has the money. So it is charged to them, the interest. So yeah, just count them up on your fingers, 16, 17, all the way up to the end of the month. Here we've got 16 days, and our loan is at 4.5% on our total mortgage divided by 360. So we'll have $393 worth of interest that your cousin will have to pay at closing to get this loan in balance for the first of next month. Because remember, your loans are month to month, and this first month, there's not a payment. So you're closing it all out and getting everything balanced for the first of next month. Then your payment won't be due until the next month because interest is paid in arrears. So you'd pay about twice that in interest the next month. We have an origination fee. Mortgage brokers are just like real estate brokers. They get paid a percent. The origination fee is going to be 1% normally. And this is a 196 loan. And that was on the total loan, not the amount of the loan, but the total loan with all these fees in it. Then they're going to have another maybe 1.5% worth of other fees attached to this. So there are your lender fees. Then you've got some other things that are going to have to be paid at closing, like your homeowner's insurance. First year paid up front. Then you're going to have 3 months of insurance thrown into the escrow. So we've got our house here. We think the insurance is going to be about $5 per thousand. So we got about $1,000 for homeowner's insurance, also known as hazard insurance. This is the insurance that covers like if lightning hits the house or a fire, anything like that, perils. Your other insurance up here covers the mortgage company in case you default. Down here, we've got homeowner's insurance, got that. And then we've got taxes. We got to put our taxes into the escrow. Remember up here, we're paying them $75 to set up the account. So we're going to put $500 in it for 3 months of taxes. Now we're going to add up step 1 and step 2, and we've got $9,200 worth of closing expenses. Add that to the price, and we got $209,000 that we got to pay. I thought it was a $200,000 house. Well, no, it's fees. Now, let's look at the next steps. Yep, I did that again. Maybe I remember on third trip. Here's our third one. Spring now, I did it right this time. We got some credits. Your earnest money deposit, $1,000. The base of the mortgage, that was the $200,000 times the 96.5. So $193,000 credit for the mortgage. And we're going to do this way, but I'm going to explain it another way as well. The seller can contribute up to 6% of the purchase price on an FHA loan toward the purchaser's closing cost and prepaids. Conventional it's 6, VA it's 4. These are, it's going to depend on the amount of the loan and all too. But just keep these for your net sheet. Now you got this, $12,000 that the seller can credit to the buyer. Now on a $200,000 house, do you really think the seller's going to give you $12,000 worth of credit? No, I don't think so either. There's another way. You can ask them for 12, and if they won't give it to you, find out what they will give it to you. You may have to bring the sales price up to $205,000 to get them to give you $5,000 in closing cost. That's perfectly fine. The other way to do it, and will probably work better, is to work with the lender. The lender can increase the interest rate by 1/8 of 1%. And if they do that, they will give you a 1% credit for closing. So on this loan, we could have said, all right, Mr. Lender, I need $12,000 worth of credit to cover my closing cost because I ain't got no money. So you can talk to them and say, work this out for me, and they'll adjust your interest rate to, what is that, about 3/8 maybe, to get you that same $12,000. And I'd rather have the money now than have to come up with $12,000 now. Now we're going to sum up all our credits. We've got these three numbers, whether you use the seller contribution or your lender did it for you. You got $206,000 worth of credit, and that will be, whoops, there we go. That will be taken from this number, your 209, and minus your credits, and your cousin's going to have to come to the closing with $3,298. That's all there is to a net sheet. And you can simplify it, but you're trying to give your client good information for them to make good decisions. And if we're going to stick with that theme, let's take this one more step, a bonus step. What will their payment be? This is the part that really shocks people. What do you mean all these? Help me understand this. Okay, well, your mortgage is at 4.5%, 30 years. Your payment's going to be $980. $980. That's reasonable. $200,000 house for $1,000 a month. I can work with that. But there are other fees and costs. Homeowners insurance. See that next number? We had that up there. We putting that in the escrow every month, $83. And our taxes, $167. What is this other thing? Mortgage insurance. Well, I told you that there's 0.85% of the mortgage added to it every month. So you're going to take your gross mortgage amount, multiply it by 0.085, divide that by 12, and you're going to add that number, which is I think 139 things in my way right there, $139 a month. No, I wasn't expecting that now. So your $1,000 payment is now $1,369. So this is why you want to get a little more detailed, because that $1,369 is what they're going to base their qualification on. So let's look at the qualification. Okay. Jump over here. Oh, no, that was in the right place. All right, got their expense, $1,369. Now, as a rule, most of your loans, 28%. Your conventional. Your FHA, you can go up to 41%. 28 and 36, and VA 41 total. But let's keep this at 28% of your monthly income. So conventional qualifying ratios, they would need to make the payment $1,369. You divide that by 0.28, and that tells you they've got to make $4,889 per month to qualify. Average household income here in Alabama is $60,000 a year. So the average person should be able to buy a $200,000 house. Isn't that nice? So your buyer's got an income of $6,000 a month. How much mortgage can they qualify at 28%? Where does that $6,000 go? Right there, space number, and the 28% right there. We're going to multiply those across, and you can afford a monthly payment of $1,680 a month. That's how you really find out what they can buy when you're first talking to them. You're doing a consultation. You just kind of give them some rule of thumb here about, I try to keep it simple and say, for every $1,000 that you finance, you're going to have to pay back about $5 per month. So if you've got a $100,000 loan, you're going to have to pay back about $500 a month. And they say, oh, okay. And they're thinking, well, I make $1,000 a week. So they need to be looking at $200,000 houses. And here, look at this. The interest rates, this is from November, I think. A 30-year fixed at 2.25%. You believe that? I can't believe that. Let's see if I can move this out of the way. Show you what this is. A $200,000 loan at 2.25%. Your principal and interest would only be $765 a month. Wow. 4.25 is more likely what we're going to be seeing spring and summer. So if they can buy now, they're going to save about $200 a month in payments. This time next year, it may be at 6%. The average is closer to 6 over time. So that same $200,000 house is now going to cost you $1,200 a month. Right here. All right, that was our buyer purchaser closing costs. Look at the sellers. Much simpler. The sellers sheet, we don't have to have 3 steps. It's only one easy step. So I don't have all these extra things and no lender cost and all that in here. Start out with your purchase price. Your attorney fee still the same. Going to split it. Divided by 2 right there. $500. Brokerage fees. This is a seller is going to be paying this fee. 5% times 200,000. The brokerage fee is $10,000. The seller, on our example, we had them paying $12,000 in closing costs. So this may have only been a $175,000 house to begin with. But you can add, as long as it'll appraise, you can add these costs onto the purchase price. Sewer, the seller's got to get a municipal ladder. It's about $50 to say there are no liens on the property from water, sewer, or anything else. Tax. The seller owes the tax in arrears. That means in the past. And our year goes from October 1st back around to September 30th. So here the seller, we're closing this on April 15th. We got to figure out how long that was since October 1st. All right, since October 1st, October, November, December, January, February, March, that was 6 full months plus a half a month of April. So there's the math on it. 200,000 times 6 months, you got $1,000 worth of taxes there. And then the extra 15 days, another $83. There's a termite bond or agreement on this property. And if there's not, the buyer is always going to ask for one. If you've got to get a new one, it's about $250, but this was a transfer and it's $150. We had title insurance. Remember that split, just like our attorney fee split. So the $200,000, $1,200 charge, don't pay half of it. So let's just total up our expenses. $24,000 off of the $200,000. The seller will walk away with $175 unless they have a mortgage, and then you subtract that to get down to the bottom. All right, how about this? All right, that's I'm going to load all this up on the internet here real soon, and I'm going to put the PowerPoint on our website, so you'll be able to go and look at this whole thing. I've got it written in 3 parts. It's actually a mortgage little segment, but I just broke out the net sheet part of it. But if you're on our website, you can go to pretty much any of these links. And if you're in the slideshow mode, this link will work, or you can click on the picture. Click the picture and it'll give you the booklet on how loans work. All right, let's close this up. Net sheets. Appreciate y'all watching.